Hi, I'm Bryan Beatty. I'm a partner at Eganberger & Weiner, and I want to introduce to you our market outlook for 2024. So where's the recession? Well, our data looks backwards. We do get forward indications, but things can turn around. And in 2023, we have a clear evidence of a slowdown everywhere except in the consumer sector. So the answer will likely be in the consumer's willingness to continue to extend their credit to keep up with the inflation that's been wreaking havoc on the country and the developed world for the last 2 years. Good piece of news is the interest rates. These are the most attractive bond markets in the last 15 years. And yields now in the 3 to 7 year time frame are very attractive for portfolios going forward. Now let's turn our attention to the stock market in general. We are of the opinion that value is a much more reasonable prices compared to growth. And so we're going to find an opportunity to increase our value exposure at particular times going forward. Regional banks will remain under stress. Now, as you can see from the chart, the big banks are very well diversified, but the regional bank sector actually holds most of their commercial loans. And so the banking sector has to get used to this new interest rate regime. This requires careful management of assets and liabilities to meet the appropriate liquidity for the banks, depositors, and creditors. And as we saw early last year, there will be banks that make mistakes. We think that regional banks will continue to be under pressure for the foreseeable future, and some will fail. Regional banks hold their bank loans on their balance sheet. Regional banks also have a higher exposure to commercial real estate, and many of these loans will become underperforming or even bad loans as leases expire and tenants shrink their footprint in this new remote working America. So we're going to keep our eye on the regional banks. We do not think, however, that it's a systematic problem to create a problem for the economy. Now let's talk about consumer debt. Consumer debt is now approaching pre-pandemic levels, but now they have higher interest rates of debt service. And as we look at the chart on the screen, you can see that delinquencies are up for both credit cards and auto loans, up close to 8% from 4% just 2 years ago. We expect that number to continue to climb. Now stocks. Value is a much more reasonable place compared to growth. However, growth could still go a little further. At some point, however, we think value is a much more attractive investment going forward. Growth was a big winner in 2023, especially in the large cap category. But growth is nearly as overpriced as it was before the sell-off in 2022. We are of the opinion that there are many more attractive opportunities as far as a risk-reward basis going forward, and will strategically increase our value weights in 2024. Ultimately, the stock market is driven by earnings, and earnings are expected to be strong. If you take a look at the chart on the screen, you'll notice the revisions for stocks in 2022. Stocks actually surprised, which gave us the rise in 2023. Next, let's talk about the election. I often get asked about the elections and their impact on portfolio returns. I know that the political climate is as bad as it gets. It only seems to be getting worse, so I understand the concern. We've had very contentious elections before, so this time I'm sure it's felt the same way, that it couldn't get any worse. The market still went on to perform the same regardless of who won, Democrats or Republicans. We recommend not letting politics guide your investment approach. Ultimately, stocks follow earnings. Earnings turned decidedly negative in 2022, and stocks sold off as a result. Things were not as bad as expected, and that explains the snapback in 2023. If analyst projections are close, the market should see higher prices by the end of 2024. The national debt remains a concern. The problem? That debt payments are now nearly $870 billion. $7.6 trillion of the $34 trillion of national debt is going to need to be refinanced in the next 12 months. Rates are substantially higher now than they were in the middle of COVID, when we used $6 trillion to get us through the pandemic. Rates at that time on a 2-year was less than 1%. Today, that rate is north of 5%. Debt payments as of the end of the fourth quarter of last year were $739 billion. By the end of this year, the payments will likely exceed $1 trillion. That's larger than either the defense or the non-defense spending. Why do I bring it up? Because I do not want anyone to be surprised. This will impact assumptions about entitlements like Social Security, Medicare, and Medicaid. Something to note, we have always factored in reduced expectations in our financial plans for clients under 50. In summary, we are cautiously optimistic despite all of the geopolitical risks and the U.S. political dysfunction that the economy remains strong. Earnings should take center stage in 2024. Big banks are very well capitalized, corporations have a lot of cash on hand, and with the additional income from our bond positions, portfolios should have a little less volatility compared to any period in the last 15 years. There's always the possibility of something that surprises, but isn't there always something we didn't expect? Thank you for watching. Follow along and stay tuned for future updates. Thank you.